Good evening, everybody. Uneducated Economist here. Check it out. I found my old hat. So, I was going to come out here and talk about a couple of things, and they really go hand in hand. I was going to talk about negative interest rates, and I was going to talk about cryptocurrencies. And really, with all the talk that has taken place right now with cryptocurrencies, there is very little doubt in my mind that it is going to definitely take place with the central banks. The central banks are going to move into a digital currency. China has already implemented one, and they just did a lottery. And from what I understand, it was quite a few. It was like 2 million people had registered for the lottery, and 50,000 people were rewarded free digital yuan if they downloaded the app. And they gave away like something like $1.5 million worth of this digital yuan. So it's just a sign, and that was like the second move. Really, they've already had it up and moving for a couple of months now, from what I understand, or what I remember, because they have a few cities and something like 3,000 merchants who are now involved with their digital currency. So they're expanding it, and that's what that lottery is all about. And I'd imagine that you're probably going to see more lotteries like that come into the future, and especially when it comes into like these stimulus packages that the governments are going to have to go into the next time that we go into a financial downturn or recession or COVID event or whatever it is that you want to call it. But because that's ultimately what it is. I mean, it it's I'm sorry, I'm going to kind of go off here a little bit, but it's really interesting how there was so many people talking about there being an economic downturn coming into the future, and that there was a lot of signs of it at the end of 2019, early 2020, and yet it was all blamed on COVID. And so I just I find that to be like a very gosh, I don't even know how to quite say it. I don't want to call it like lies, but like more of a distraction from the problems that lie within the economy. Because right now you got the Federal Reserve who is screaming like more stimulus, and it's interesting because now I'm reading a lot of opinion articles that are coming up talking about how the Federal Reserve is really screaming like we're out of ammo and it's up to you to do something about it, talking about the government going into more fiscal stimulus packages and spending and whatnot, and that they'll be the provider of facilitating this move, but that they're not going to be able to do anything about getting the economy to continue into the recovery if it isn't for the government doing more stimulus spending. Now I think about that, and I think about like, okay, so many Federal Reserve chairmen and just economists in general over the years have stated about how the United States government, needs to get their deficit spending in order. Okay? And now if you relate that down to alcohol, it's like telling an alcoholic, you need to get your drinking under control. And every time the Federal Reserve said this, they handed him a bottle. And right now, I mean, it was just not too long ago. It seemed like it was maybe just a year or two ago. Jerome Powell was saying the same thing. They need to get their deficit spending in order. It's one of the major concerns of the bank, of the central bank. And now, right now, they're basically saying you need to go into more deficit spending. You need to do these stimulus packages, and you need to do them in a big and a major way. Another way of saying that is like, don't get your drinking under control. You need to drink. In fact, here's bottle after bottle after bottle of tequila. Go for it. That's what they're saying. So now, when it comes to negative interest rates, this is where the Federal Reserve will begin to start using their ammo again. Because ultimately, they're out of ammo. They're at zero interest rates right now, 0 to 0.25. Now, if you're not familiar with what that means, it's the federal funds rate. And it gets very difficult to understand because it gets very complicated quickly. But I'm going to try and explain what's going on when it comes to this Fed funds rate and when it goes negative. And now, to understand what the Fed funds rate is probably easier to understand what was happening before going to zero. Because even before like the financial crisis, because typically the way that Fed funds rate is, because it's a target. It's not really like an actual rate that's like, set in stone. It's more like written on the wall saying, hey, this is a target rate. We got to shoot for this, boys. Okay, this is what we're going for. And so when it's at like, back when it was like, say at 0.25 or 5.25, right? It was at 5%. Let's just say, I don't know why I threw in a percentage, but say it was at 5%. In order for that 5% target to be maintained as a Fed funds rate target, this is the banking lending that takes place to each other. Okay, so now follow me here. When a bank, the big banks, at the end of the day, some of them were in need of reserves and some of them had excess reserves. The ones who had excess reserves would lend it to those who were in need of reserves. This overnight lending to each other was the overnight lending rate. Now, what the Federal Reserve would do would buy treasuries on and off these banks' balance sheet in order to achieve a lending rate that would be that Fed funds target rate. You understand? So these banks would lend to each other at the end of the night, and if this rate was getting too high, they would start, buying treasuries off of them or adding liquidity or pulling, treasuries out of these banks in order to adjust that overnight lending rate to match the target Fed fund rate. Does all that make sense? I hope I'm explaining that simply. Anyhow, over the last year, it's changed quite a bit, because now what you have is you had this overnight lending repo rate, which really started setting target lending rates out there in the rest of the economy. So there was a lot of changes that has taken place since then, but that's what the Fed funds rate would typically be. That's what, when they were talking about interest rates at the Fed funds level, that's what they're talking about. They're talking about that target rate and the overnight lending rate that these banks do with each other. But like I said, once it dropped down to, 'cause a lot of things have changed. They put on what do they call it? They had a lot of names for it. Abundant reserve system, where these banks didn't have to lend to each other on an overnight rate. So it ended up being like deposits at the Fed. And so the overnight lending rate was the interest on excess reserves over at the Fed level. So these deposits, anyway, a lot of things have changed. So basically they flooded the banks with a bunch of money during the quantitative easing program. Some of these excess reserves landed at the Federal Reserve. They remained as deposits at the Federal Reserve. The banks used them as, collateral in order to do other lending. But this is where it starts getting really complicated. And like I said, I don't want to go too deep into it. I really just wanted to kind of explain where negative interest rates are going to go. So that's where they're targeting. That's the negative interest rates. Because a lot of people think negative interest rates means that I'm going to get I'm going to take out a car loan and I get to pay back less than what I borrow. That's not exactly it. It could end up in something like that, but that's not what they're talking about. They're talking about those lending rates up there at the the big banking level. Okay, so can it get down into the deposit levels? Yes. As these big banks, if they are charged in negative interest rates on their deposit at the Fed fund level, at the Fed, at that Federal Reserve level, then everybody who is like a customer of that bank who has deposits with them would be like a nuisance to them, because they would have to have those on deposit. So they're going to in turn make it a difficulty for them to deposit money with them, because if they're going to get charged a deposit negative interest rate on their excess reserves, then they're going to want to do the same thing to their customers. And so you can see how this kind of follows down the line. Now, there is situations in which it actually has made it down to a retail level, to a customer, a mortgage. And there was, I want to say it was Denmark. I think it was Denmark who had, at one point, had some adjustable rate mortgages. And the demand for these mortgage bonds had grown so big by these investors over there. At one point, they didn't even care about what the interest rates were that they were yielding. They were just looking at the price momentum. And they saw these prices going up, 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 up. And so they were just buying in on these things, not really paying attention to where, at least in my opinion, they weren't paying attention to what the yielding interest was on these things, because they turned negative. And they had a negative interest rate to them, which meant that these people who had these adjustable rate mortgages by these banks or whatever, who got these mortgages into negative territory by paying so much for them actually got to pay back less on their principal than what they owed, which I still had a hard time trying to wrap my head around that a little bit. But yeah, that's true. It's just like, the people who essentially bought their mortgages were paying more for it than what it was worth. And they had to pay back less than what they owed on a principal payment. Now, I think that was only for a few months that lasted. And then, it moved back into positive territory again. But still, it does happen, and it can happen into that level. Now, when it comes to all the way down to like the depositor, like you and me, we go down, we put our paycheck into the bank. If that was to go negative, the banking system would immediately fail from the depositors not putting their money in the bank, because what they will do is just pull it all out in cash. There is no way that anybody is going to leave their money in the bank knowing that they're going to collect a negative interest rate on it, that they're going to get back less than what they put in, when they can just simply hold the cash and put it under the mattress. So that is the problem when it comes to the banking system. And they know this. And that's one of the reasons why you don't see the Federal Reserve going negative with their interest rates, is because they simply can't. There's too much cash in the system for it. Now, a lot of people are going to argue with that point. And there is a lot of great arguments about whether or not they can or cannot go negative with their interest rates right now. A lot of people will have some great arguments for it. And in fact, I would love to see them down in the comments for your reasonings for why they could or couldn't go negative with their interest rates. But ultimately, they are going to have to go negative with their interest rates, because that's the only ammo they have. Otherwise, they're just relying on the government stimulus packages to do all the work for them as far as monetary policy, because being at zero interest rates is pretty much got them dead in the water. All right. The IMF has already stated, and I'm not saying I'm the first one to talk about this, but I was probably one of the first ones who really took it to consideration that this is the way it was going to be, where they were going to institute a central bank digital currency in order to take interest rates negative. Everybody else looks out there and says they are going to institute central bank digital currencies in order to control the masses. Yes, that's true, but they already attempt to control the masses, and they're going to do it, and no matter how they go about it, really, in my mind, it's all about taking interest rates negative. Because if they can take the currency, the cash, out of the system, then they are able to take negative interest rates all the way down to the depositor's level. That means you and me, we go and put our money into the bank, and we get charged a negative interest rate on it. Now, how are they going to be able to get the cash out of the system? And this is where it really starts to come into play, because what they're going to do is they're going to put this central bank digital currency into circulation, and they're going to call it a really good thing. They're going to say, how there's a bunch of unbanked people, and they need to be able to have access to money and to, whatever Fed relief, government relief, whatever. They need to be able to access this money, and the Federal Reserve is going to make that accessible through these applications and these digital wallets. Okay. All of it is going to be presented as a good thing. Once they put it into circulation and people start using it, and it becomes a normal thing, and people don't even think about it anymore, because they're not even going to be concerned about whether they're holding cash or e-currency or the Fed coin or whatever they want to call it, the central bank digital currency. These things will be trading one-to-one. But over time, they're going to want to start putting this negative interest rate into play. And they can't do it with the cash in the system. So what they're going to do is they're going to start devaluing the cash to the e-currency. And now they're not going to say, hey, we got this trade value that's going to go on. What it's going to be is going to be a fee. They're going to charge you a fee to withdraw money, cash, and charge you a fee to deposit money. So now all of a sudden, they can start messing with the interest rates at the depositor's level with this e-currency to match whatever it is that they're charging for a fee on the dollar. You see where I'm getting at? So now all of a sudden it doesn't behoove you to pull your money out in cash, because you're going to get a charge an interest rate the same as the negative interest rate that you have on deposit with the bank. How they're doing this? So no matter what you do, you're going to get stuck. Now, once they have you locked in on this digital currency, everything is about control after that. So who knows how limited people will be on what they can purchase. I mean, one of the articles, and I'll leave a few links down in the description, one of the articles is about the Russian ruble wanting to go digital. And one of the things they say in it is to limit the amount of foreign cryptocurrencies or foreign digital currencies that people can buy. And I thought, it's not just about limiting the amount of currency leaving the country. It's about limiting the amount of currency that people can do with it in general. All right? I mean, that's what it's really all about. So what else did I want to add in on that? I guess that would probably do it. I don't know. There's probably a bunch of stuff I should probably talk about, but it's starting to get dark out here, and it's probably a long enough video for you guys. Uneducated Economist, you guys let me know.